money is given out as loans, and whenever these people want to withdraw, they can withdraw. There may be times when the amount of the demand for return of deposits could be higher than the money that the loan repayment is taking place. The bank cannot go to the person who has borrowed the loan and say, pay it on demand. All loans have a payment maturity date, payment date, and all deposits are withdrawable on demand. So this creates liquidity risk. The bank may not be in a position to meet the demands of its customers, and therefore, if the entire amount of Y is lent out as loan, there would be problems. Where does the bank get its money to give withdrawals, to meet the withdrawals from this account? Fresh deposits of the day and repayments from the loan. So you cannot have this situation. If you have this situation, you are in trouble. Okay. Therefore, even if the regulations are not there, even if there is no regulation, even if there is no problem, the banks will maintain liquid assets. Some liquid assets.
Liquid reserves basically.
No.
Over and above reserves, you think?
Correct. It will keep some cash and some liquid assets. What are liquid assets? Liquid assets are assets which can be converted into cash without loss of capital and which can be converted with ease and immediately. What are these liquid assets? In principle, or rather by definition, in a financial market, they are fixed income securities because they are the ones with the lowest capital loss. And government securities, fixed income or government fixed income securities.
Treasury bills is the same?
Treasury bills, bonds, any debt instrument issued by government. So far there is no regulation, but as a banker, because of my liquidity risk or the uncertainty of the cash flows, cash inflows to meet my cash outflows, on both sides there is uncertainty. And the fact that they can demand their entire money back and I cannot ask my money back unless it is due, this is the liquidity risk. I maintain a certain proportion of my certain percentage of Y or my total deposits, I would on my own maintain as liquidity to avoid risk. The second thing that happens because of the payable on demand is what is called credit creation. That is, the depositor who gives the bank some money, who opens an account, does not lose the purchasing power. If he has 100 as his money, he keeps 100 in bank A, he keeps 100 here. The bank A gives a loan to a customer, and let's say 60 of that is given as loan because of various things that they keep, they want to be safe, and this money goes to, let us say, bank B. It could be a customer in his own customer who opens an account there, or he withdraws it and has his own account and he puts his money there. This customer who has put money here can utilize this 100 immediately or tomorrow or day after tomorrow, whenever he wants, because it is withdrawable on demand. So at this stage, the first stage, the purchasing power or the amount that can be used to spend the wealth is 100. At At this stage, this 100 continues as it is. Sorry, bank B is 60. So at the second stage, this is first stage. The second stage, you have 100 plus 60. Because this guy has got a loan and he can use it whenever he wants. Let's presume that he doesn't use it on day 2 itself. He waits for some time. Then the bank B has a deposit of 6. And let's say they also give, it goes to bank C, let's say, 60, sorry, bank B gives a loan to a customer, say 40, and that customer puts the money in bank C. Somewhere around there.
Some proportion is being kept for the bank.
Yeah, I'm keeping a proportion of, say, 40 is kept here, between this and this. Cash plus liquid assets, I'm keeping whatever is the proportion. Higher the proportion, the lesser will be the loan that is. At the second time period, end of second time period, this guy can withdraw, and this guy can withdraw. And the total amount of purchasing power or the amount of deposits that are there, this comes to 200. So in 2 time periods, 100 has become 200. I have not violated anything, I have not said anything. I have not done anything, it's just pure banking business.
But there could be multiple of banks. There could be this number.
It will continue. It will continue. It could be the same bank, customer A, customer B, customer C. From customer A, the second time period, bank gives to customer B. This is normally credited to an account. Account is opened and you credit 60. He can use it. The deposits go up. Then again,
40 cents of
40,
portion, then
yeah.
again credited to some other person, then again some portion. So it will be after a period of time, it can be zero.
It's a kind of what we call attenuated this thing. It might become zero, it might become insignificant. But that can be seen from the time series data, how much it is there. But the fact remains that the very transaction of one person giving a deposit to a bank increase and it deposits, based on these deposits, the bank utilizes that money to give a loan. It increases the purchasing power in the economy. And that is in economics called credit creation, which to be understood as increase in the money. And if the money supply goes up, it has monetary implications. Interest rates could go down, inflation could go up. There is a monetary implication, and therefore we will have to regulate. And the last reason, that last thing that happens is, because of this liquidity risk or because of anything, there are linkages between one bank and the other bank. Like for example, the customer has put it in bank B, or they borrow and lend to the others, and banking depends on faith. If one bank has problems, there will be problems with the other banks also, and this is called systemic risk. A run on one bank normally results in a run on a couple of banks.
Now, credit creation and the standard macroeconomics theory.
Yeah.
We normally assume CRR to be 10% and the...
No, we have not had CRR so far.
No, but credit creation, effectively that's liquidity, liquid assets.
Yes.
It is something to do
I'll
with...
come to CRR because we have maintained 40% with cash and liquid assets.
Isn't it too high to maintain? I mean, in India we have this SLR and CRR, so it's close to 40%.
High or low, boss, what I am arguing and proposing to you is that whether you have a reserve bank or you don't have a reserve bank, whether you have a socialist system or you have any system, to keep my business going, I have not brought in any regulations so far. I am doing a business of accepting money as demand deposits and I am giving loans. Just to see that my business, I don't get into trouble or my business is sustainable over a period of time,
No, that is true. That's kind of a very prudent way of looking at 40%. Now, when the economy is booming and you have a huge demand for your credits.
Yeah, we'll come to that. There may be imprudent fellows.
No, I mean, if you look at the how, I mean, I was reading history of banking a little bit and how the banking as an institution evolved. Old system, there used to be these goldsmiths.
Yeah, same thing. We discussed
Yeah.
this.
Goldsmiths basically used to.
Bhusnurmath also.
Yes, little bit he has given, but I think it's another. I think in the web link I found that Robini's website has a better kind of a details of that.
They were either goldsmiths. Why goldsmiths? Because coins used to be struck by goldsmiths. We had gold coins earlier. And gold coins were the currency, money basically. And anybody could, with a certain required purity, strike the gold coins. And the weight of the gold mattered.
No, that's where the trust comes in also.
Yeah.
Who is doing it and how.
Yeah, that trust is the purity.
Purity, but again, if I have a lot of trust on me,
Yeah.
then I can dig out that.
And that trust was, that's where the regulator came from. Even though you could have, let's say, so many grams or milligrams of gold. Yes, ma'am.
The 10 million?
You want it? So the trust came in there because, I mean, I really have not studied, but you visualize, I am a goldsmith. And why do people have trust in me? Then my son takes over, they may not have trust in me. Or the group takes over. But one person who could ensure the quality or the weight or whatever you want to say, the quality of gold and the weight of the coin, each coin, was the ruler.
That's effectively the legal tender. That's
Linear age or something it is.
that's where the legal tender business came in.
Yeah.
Before that,
Then the king or the emperor said, these goldsmiths will strike you. Or they will prepare the gold and give it to him, and he will issue it out. Like, for example, very few people know that, I mean, now, of course, it's China. Hong Kong, HSBC was the, though it was a commercial bank, it was also issuing notes.
it's still issuing, I think.
But still, I have not studied.
I went 2 years back, so I have this currency notes, which is HSBC
HSBC
and
is
Bank of
liability.
Bank of China.
Now it changes.
No, Bank of China also is a commercial bank. People's Bank of China is the central bank.
Okay.
So it's now one Chinese commercial bank and the one HSBC, which is a Hong Kong, is a private bank actually. Bank of China is a
private bank.
yeah, whereas the Bank of China possibly is a public sector bank. So
That seniorage or whatever it is called, that can be given on that. But that is regarding money.
yeah, but the thing is, the whole issue, since the trust you brought in systemic risk, somewhere the goldsmiths also, what the banks today go through is something which the goldsmith also went through. If somewhere you violate that trust, then what happens? There will be that this first that not
Yeah, well, but then goldsmith goes under, he goes under. That's all. Very few are people who use it.
but the thing, the whole payment system will be undermined.
Yeah.
If there is a sufficiently reputed goldsmith, if he has some kind of violated some trust, or people actually, even if he has not violated trust, but people start believing that, even then that goldsmith.
Yeah, like if you read Count of Monte Cristo, there are some of these names mentioned who are the bill discounters. I mean, somebody says that, I signed this bill, which means I will make this payment on such and such date. That paper becomes currency. Actually, all these currency notes are promissory notes.
Yes.
Promise to
Yeah,
pay the
but now we have a very formalized social system. But it could be that we had saukars and things like that in India, or in the trade you have a big trader who was acceptable to the community.
So even now there is a recent evidence. I mean, when the Soviet Union, the East European countries collapsed, so one of the major things what happened, the currencies lost trust because there was no state as such. So effectively, a lot of the companies, they had everything in place, but there was no money to kind of make the system go.
Yeah.
So what these companies did, they said they evolved their own this bill of exchange kind of a thing, promissory notes, which actually the company which is at in the vertical whatever, suppose it's steel maker, iron ore and all that marketing company. So they start issuing themselves these promissory notes, or you can call it currency, and that kind of took the place.
On a minor scale, we have a small problem in the because the coins are not available. The Mool fellow puts a signature and gives a small piece of paper, which is acceptable. Of course, we don't go and give it to somebody else. You go and retrieve it.
Even DTC used to start that.
There were some fights saying that this fellow said this is not my signature. then now nobody accepts those slips. But that is fine. In this case, it is just that what proposal I am making or what I am building up is that till now there is no regulation. But because it's public savings and public savings are good for the country and the authorities are required, they encourage public savings. We need to have good savings, etc. You want a public to save, you must provide some place where they can keep their money safe. And therefore, public savings, and therefore, we have deposit insurance. I have not found any other reason for deposit.
No, there's a small, I agree with you, but I think in the technical jargon, public savings is actually known as government savings. As what you're referring to is actually household savings.
Savings by the people.
Household savings.
Household savings. You can say household. I stand corrected because we talk of public debt, so this is not household savings. If you want household savings, then you must encourage it. You must give them a safe place to keep, and that safe place is bank. And if you want them to keep here and feel comfortable and increase their savings, you must give deposit. Then we can take off saying that how much of deposit it is, but we'll leave it at that. Second one, it's part of the payment system. Like he said, East Europe, East Germany, we had problems.
This was Poland I was talking about.
Poland, there was problems. World War II, there was a lot of problems. What do you do? In India, we had a problem because how to make payment to the armed forces or the paramilitary forces during the Assam agitation. So we had to send our money there. It has to be available, otherwise your system doesn't work. Money should be there. How to give money as salary for them. So we used to send tons and tons of currency there, and it used to be distributed as cash. Payment system, there is no need to waste time on that. Credit creation, increase in money supply, decrease in money purchasing power. System in place. Because of all these, regulation is necessary. Now, payment system, that is why, if you see the RBI publications, they have a division, now they have a CGM in charge of payment system. So it's very, very senior. And since 85, it was recognized. We used to wonder why RBI is laying so much stress on payment system, because that's not part of banking as such. If you define banking as this, in fact, this is the legal definition. In Banking Regulation Act, it is written, accepting deposits payable on demand. Not banking. Yeah, banking.
How is the post office treated?
Post office savings bank is treated as small savings.
Because they don't give loan, they give it to the government. Is that the reason?
Yeah, the money goes into the government kitty. It goes into an account called PNP account. PNP account is one of the government accounts, like railways, defense, PNP, one more. Then you have the consolidated fund of India. That doesn't go to the consolidated fund.
That's more like a financing the fiscal deficit of the government.
Ultimately, yes. In fact, I have a proposition. I know all these ideas of writing papers for small savings. We have the protected sector, the government sector, where pension is given. We have the militant sector, or whatever you want. Organized sector, whose salaries, etc. are there, but they don't have a pension.
Which is why we are starting the new pension scheme. I think it started last 2-3 years.
Something like that is started, but in that you are saying you will do this, you will do that. But we have a simple thing, the public provident fund.
Yeah.
You put the money there, or secondly, you can issue in UK and US, they issue what are called index bonds. The problem of savings is loss in purchasing power, which is inflation. So you can have an index linked one. So there are 3-4 things which other countries have tried, which we cannot do.
Japan actually has done recently. I don't know, you must have read it. Japan has converted postal system into a bank.
Yeah.
And that's now the biggest bank in the world.
This one, Deutsche Post. Or Deutsche Post, as some people call it. He is the bank. Japan Postal Savings is the largest bank,
Yeah, in the world.
largest bank in the world by volume. So they are there, but these are the core reasons. The more I talk about, I come down to these four, which cannot be, even if you have the freest of the market, Milton Friedman ka boss, granddad, you will have to take cognizance of this. You can say we are not bothered, but this no country can say not bothered, and therefore a close eye on the bank is required. This cannot be translated into this. What can be done about this payment system is you must ensure health of the bank. That's the contentious issue. Now, credit. How do you ensure health of the bank? If you take these three major risks that we are talking about till now is liquidity. To handle the liquidity risk, we had liquid assets. Now, as he said, some banks may not. Some banks may be exuberant. Some banks may think will manage. You heard of Ponzi schemes? Most schemes which have failed are Ponzi schemes. What are Ponzi schemes? You know? You don't know. Ponzi schemes are very interesting. We start a fund. You can withdraw later on whenever you want, etc. This bank is like that. Ponzi schemes are schemes in which payments to be made are made from cash flows received in that time period. So it's like we collect a lot of money and I utilize it for something.
It's like chit fund, you know.
Like chit funds, yes. But chit funds is slightly different. In chit funds, the money received in that time period is given out as loans. In the Ponzi scheme, I take the money, I buy my land, etc.
But it's not, I mean, I don't know, there are some of these chit fund schemes where there are members, suppose there are 20 members, everybody is contributing say 1,000, so 20,000 collected. Now, if one of them who wants it, he bids for it. Whosoever bids the lowest gets the money.
But in Ponzi scheme, I get all the money. You are all members who deposit. Whenever you want, I will give it. But it works that way that you want money, to withdraw that money, she is giving me money.
So you balance one against the other.
That money.
So whatever you are saying, still it is going in the unorganized sector because they bid and they don't give money in advance. First of all, they bid for the money.
No.
After that, they collect. Whatever the loss will be there, it will be divided among the.
That's a return in a way.
That's a return in a way. Maybe 100 rupees, maybe 150 rupees.
Yeah, but in Ponzi scheme, Madoff was a Ponzi scheme. You heard of Madoff, no?
Recently, the crisis which is
Google it. It's got very interesting.
Madoff.
But sir, in this scheme you are talking about, it was added some rate of interest was to be deposited. If I'm taking the amount from the bank itself, what will be the transaction cost in that?
No. See, bank, once you give me money, let's say you give me 10 people give me money. I use it for something else. I mean that I don't show it to you at all. But you want return, right? How is return given? Say every month I pay something. Where do I pay it from? If the banks pay you interest from the interest they earn on this. They pay you maturity from the maturity that comes from here. Final proceed. But in a Ponzi scheme what happens is whatever interest you want me to pay, I will pay. But that comes from fresh deposit.
So the rate of interest depends on just like term deposits or is it taking the interest?
No, we'll come to the rate of interest. But there is a rate of interest. So anyway, let's finish this. Because it was a liquidity scheme, a liquidity problem, and we need to do a percentage of that to be kept here, it is imposed. So the imposition that happens is some percentage of your deposit should be in cash. And where do you keep it? It's very difficult to keep it in the building. So you keep it with RBI.
That's a CRR.
That is CRR. So RBI account holds CRR. Also, banks have to pay each other. Just like this customer for transactions opened an account with this bank, This bank has to make payments, receive payments for transaction process.
You're talking
Also,
about SLR.
yeah.
No. That's
just
the
for-
clearing house.
Interbank transactions.
Clearing house, basically.
For transactions which are interbank transactions, which are clearing, which are foreign exchange transactions, there are lots of
Demand
transactions.
deposit.
Checks and all
Yeah,
that,
we
right?
call it that for transactions purposes also, they maintain an RBI. I'm just trying to fill the balance sheet now.
That's like the excess reserves over and above the
Yeah.
CRR.
That's called excess reserve. In US we call it excess reserve. In India, whether you maintain for this or for this, we take the entire amount available with RBI as reserves, as CRR, towards CRR.
Excess reserve also is considered as part of the.
You need not maintain it. In the sense, what I'm trying to say is that in India, as of now,
But if you don't maintain excess reserve,
Yeah.
how will your daily transactions go on?
I'll have to go into technicalities. I'll tell you. Cash, something has to be maintained. Let's say 1% of, or let's see, cash, actual cash for giving. Then there is an RBI account. For RBI account, I maintain two things. For two reasons I maintain the balance. One is for transactions, say interbank transactions, interbank transactions, and the other one is CRR imposed by Reserve Bank. Now it is an imposed thing, even if I don't know. Okay.
Okay.
Now CRR is what, 4, I think, 3.5, 4.
I think it was 5.5, but they have reduced it certainly.
Let's say 5% of Y. Everything gets linked to deposits now. Now, what RBI says is that 5% of deposits. Now 5% of yesterday's deposits or 5% of it can't be today's because I will know only at the end of the day. So this became a problem. Transactionally, administratively, what they do is there is a Friday. On some Friday it was issued, the circular. How does the Reserve Bank know what is this? You get data, no? Where is this data emanating from? When I was a professional, every Friday we used to report all this data to the head office. Head office used to compile it and give to the Reserve Bank. As of now, every alternate Friday, it is called reporting Friday. Every reporting Friday, which happens to be alternate Friday. Let's say this Friday is the reporting Friday. As of the end of business on Friday, all the liabilities and assets figures have to be given to the Reserve Bank of India. Consolidated figures for the bank have to be sent to Reserve Bank of India. Now it is simple because it's online. Earlier you had to give a thing signed and all that. That had to be sure. That is how Reserve Bank of India gets the data of bank. And from that data, they may check out, off-site they check out that you have maintained enough of CRR or SSR. Okay? Which means that from one reporting Friday to the next reporting Friday, there are 14 days. Always. The first, this is the bar, I have reported already. I have to maintain CRR as of this. Actually, it is as of the previous one. But let's say I have to maintain as of this day. So, CRR, there are two types of maintenance administratively. One is that, let's say the reporting Friday comes to something and CRR I have to maintain 100 crores. That means on any day following this reporting Friday, for 14 days, my account with the Reserve Bank of India should not show a balance less than 100. That is maintenance of CRR. Okay? That's how it is in the US. You will have to maintain this. That is where we say excess reserves. Suppose you have 105 crores, that 5 crores you can lend to some other bank. In India, we follow another system. We call it the daily average. what you maintain on day 1, day 2, day 3, day 4, day 5, day 6, RBI is not bothered. Now there are some more restrictions, but RBI says that on an average, you should have maintained 100. That is, CRR is to be maintained in the RBI account on an average. Which means I can have 0, I can have 500, I can have 200, I can have 10, I can have 20. You take the average, you add the daily balances, divide by 14, and that should not be less than CRR. Why they do this is that it gives a kind of flexibility to the banks to maintain this. This was a system, say, in 1970, 80, 90.
But this
You
is
could have zero balance with Reserve Bank
because earlier system.
earlier.
There is a possibility of misuse of the system.
Not misuse, there is a possibility of misuse or
So
ignorance
I get
or
one.
adventurism.
You can get one in one day, and that basically. Was it Harshad Mehta something similar to this?
I think there was no crisis as such, but then the Reserve Bank started thinking of all these things.
Because Harshad Mehta something used to say that he
People
used to.
like us worked in that market, so we also got a feel of how it happened. Yeah, as soon as the time maybe, see what happens is, we know how much to maintain, then the call money rate is very high.
So I'll just withdraw it for a day and then.
Yeah, I'll lend it to you. And there were a few crises when that is why some banks defaulted. Default is when your average RBI holding, RBI balance comes below CRR. That's a very serious offense. So when banks default on CRR, then there's a lot of concern from the Reserve Bank as well as a lot of penalties being paid, etc. So a few days, this problem. What happens is, let's say, this is how the trading takes place. Okay. Now we have 2 weeks time. Today is Saturday. I have 100 crores in my account. I need to have 100 crores. I have 100 crores. Fine. I just sit quiet. Don't touch it. I need for transaction. So okay, 105 crores I keep. I have kept 100 and I have kept 105 crores. I am a very prudent banker. I gave you the reasons why I need to keep. I am keeping. Very fine. Then I have a feeling that interest rates are going to fall down. Today call money rate is say 10. It is likely to go to 5, 6. So what do? I lend today. Because it amounts to a lot of money. Each bank keeps something like 2,000 crores or 3,000 crores, but let us say that. I earn a lot of money. Why not? If I lend today, see I have to maintain 100, you draw this as 100 lines. I have this. So I lend, my balance comes here. Today's balance. I have to make it up. One of these days, somewhere, I have lent, say, 50 crores. One of these days, I have to borrow 50 crores. Then the average will become 100. I have 100. I lent 50 today. I have gone below my requirement. One of these days, I can borrow. So if my prediction comes true, from 10 it falls to 5, then on that day I will borrow extra. And I make up the money. Why Reserve Bank allows this is that we need to have liquidity in the corporate market. If all banks get their CRR, if all banks maintain that CRR and not borrow or lend, there will be. This argument is similar to speculation is important for liquidity in the stock market. If you don't have speculators, the stock market cannot work efficiently.
That is what the thing is. Everybody is equally rational. The stock market not function.
It doesn't function. Here, if everybody is equally prudent and not adventurous, then the call money market will come. And why do we need a call money market? Because the cash flows of a banking, of a particular bank, however much you try to, be safe, cautious, etc., are not predictable. Which means there is a lot of uncertainty. These guys may withdraw. If some bank wants to withdraw, some customers want, let's say huge one, like Tata suddenly wants to withdraw all the money and pay it out and send it abroad. It goes out of the bank, isn't it? So what does this bank do? It goes to another bank to borrow. The last one is borrowing from RBI, it goes to another bank to borrow. So that kind of liquidity is there. I think these are all the reasons why this average system is good. Then subsequently,
Another interesting thing could be that I can just maintain, since I have 14 days, first 7 days say I maintain higher. The next 7 days I can always maintain lower. And then, I mean, one is the interest rate part you already mentioned, that you can take the advantage of the changing interest rates.
so you won't believe if you had seen, I've done this work. If you had seen my telephone bill, which used to be in those days something like 70,000, 80,000, 1 lakh so around so per month. My telephone bill per month. I had 4-5 phones. No mobile, all telephone phones. The number of calls on Saturday used to be the highest. Friday night and Saturday. Saturday early morning, my 7:30-8 बजे से शुरू करता था. Just to predict whether interest rates will go down or will go up. Because if they are going to go up, borrow now, as he said, you get a lot of money, keep it. We used to call, the technical jargon in the market is called products. They are called daily products.
So you predict on the basis of the daily products which are in your hand?
No. Daily products means, one is that I have 100. I need 100 per day. I have 1,400, 1,400 products I have. Okay? If any day I sell, let's say we call it sell by the way, we sell money. So if I give out 50 crores, my products have come down by 50 crores. And one of these days I have to borrow them. So there became a system, it is a little difficult to, it was called product lending. So let's say somebody lends me 50 crores products, crores of money in products, which means he will deliver me 50 crores whenever it is comfortable to him. यहाँ दे सकता है, यहाँ दे सकता है, यहाँ दे सकता है, यहाँ दे सकता है, या तो लास्ट में दे सकता है. Why? Because that's the product. That's the way of borrowing and lending depending on his cash flows he would give. So a lot of things that emerged there. But to cut a long story short, Reserve Bank got concerned about this. Sarapur was there.